I've always wondered myself, why do we have to hear this every night, what the stock market is doing?
Just as markets evolve and go through cycles, I believe portfolios should adapt as well. In fact, during one of Berkshire Hathaway's Warren Buffett's annual meetings, when asked when and why he decided to sell some of his stocks, he replied that there could be various reasons.
We generally sell, well, we would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. So I would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. And that's a different equation. So now we sell really when we think that when we're reevaluating the economic characteristics of the business.
Of course, his favorite horizon is forever, but in the past, he needed capital for an investment when he saw significant potential and had no choice but to sell other stocks to raise that capital. At the current time, he sells when he loses faith in a particular company or when the macro environment changes in a way that is unfavorable for his investment. Even though I'm a long-term investor, I usually refresh about 10% of my portfolio during the year. My strategy is mostly to invest according to market cycles and developments. This means I have a dream portfolio with companies in which I have absolute faith and know why I'm buying them and, more importantly, for how long I'm buying them. I try to smartly diversify across sectors so that I can invest in different parts of my portfolio at different times. For example, at the beginning of the year, I allocated most of my funds to chips and chip companies, and then to Coinbase. I stuck with this strategy until about mid-year when both were performing so well that I decided to reassess my focus and moved more towards value stocks and stocks that I believed were undervalued. I started investing more in Disney, Starbucks, and the energy sector, which was down at that time. The first two titles haven't moved much since. I'm slightly in profit with Disney, and with Starbucks, I'm a bit in the red, but I took them with a long-term perspective. The market changes are expected to start showing more next year. I'm now over 10% in profit with Oxy, and I'm changing my focus to a different segment of my portfolio again. This video is about that, to show which stocks I'm gradually increasing my investments in and, most importantly, for what reasons and what my hypothesis is when approaching them. I'm looking at 3 stocks from 2 sectors, and I'm not going all in. I'm still quite cautious about the market because I believe there's still a significant chance that it might go lower, not significantly, but the data doesn't show any major reasons for the stock market to go up. But now, let's talk about these 3 stocks. First, I'll take perhaps the most controversial and risky one of the 3, AMD. First, a brief introduction. AMD is the 3rd largest chip manufacturer and is also among the top 50 most valuable companies in the world. It focuses on producing processors, APIs, GPUs, and chipsets. The production is outsourced to external suppliers. TSMC in Taiwan manufactures GPUs, while CPUs are produced by GlobalFoundries in collaboration with TSMC, and chipsets are manufactured by GlobalFoundries. AMD's biggest competitors are Intel in processors and chipsets and NVIDIA in GPUs. As for the stock price, apart from AMD historically succeeding in gaining market share from Intel, especially in recent years, the business is quite cyclical, just like other chip companies. The overall revenue graph reflects the peak in graphics card sales. However, I believe AMD is doing quite well. It's evident in its free cash flow and profitability, with solid margins of around 40%. But what might worry many investors are the valuation metrics due to the high volatility in their earnings. For instance, the price-to-earnings ratio fluctuates significantly from quarter to quarter, always staying in the higher range. This is because the expected results in the coming years already include quite substantial future growth, which is very ambitious, and mainly driven by the expectations of AI growth. This is where my hypothesis starts. Many investors tend to compare AMD with NVIDIA, and either they doubt AMD because NVIDIA is about 5 years ahead in AI development, or they rely on the assumption that the demand will be so high that both companies will grow. I believe that NVIDIA is not a direct competition for AMD, as you need to look one level deeper and understand how AI works. AI can be simplified into 2 parts. First, you need to train the AI model, which requires significant amounts of data to teach algorithms how to operate based on that data. This is the training part, where you need the most powerful AI chips, which NVIDIA produces. These are those famous H-series chips, with exorbitant prices. Even Google has stated that these chips are expensive for them, and they might develop their own, just like Amazon. So, there's something to it. We are still at the beginning of the AI era, and everyone wants these chips, which is why NVIDIA is skyrocketing. But then we move to the second part, which is interpreting the results. Once the model is trained, which can sometimes take years, you need to interpret the output. This is the inference stage, and for this, you need different chips with slightly different characteristics, and they can work in data centers or on end-user devices. In this segment, there's currently no market leader, not even NVIDIA. This segment is not that big yet, but it's expected to make up around 85% of the entire chip market. AMD is currently focusing on this segment. AMD doesn't want to create the best chips for training because it would be very expensive. However, they do want to dominate the inference chips. Be aware that this strategy could take 5 to 10 years to pay off, and it's not for short-term investors looking for quick gains. This is why I sometimes take advantage of market dips and slowly build my position in AMD, without rushing. Recently, I made a mistake by not buying AMD when it dropped below my fair price of $98. I was too greedy and waited for a bigger dip. The next day, it shot back up, and now it's trading about 10% higher. I'm waiting for another dip, and this time, I'll stick to my strategy. I wouldn't be going into AMD if I didn't believe in the CEO. AMD took over almost a decade ago when it was almost bankrupt and proved that it could manage such a company very well and make the right decisions. Trust in management and proper management analysis is crucial when investing in any company.
And then what do you need to do to be world-class in manufacturing? It's a different set of skills. And the business model is different, the capital model is different.
Now, let's take a look at the second stock I'm currently buying, which is S&P Global. It's not as attractive a business as AMD, but it offers reliability and long-term returns.
Can you imagine a more exciting time to be in a company like S&P Global with our rating agency, the index business, market intelligence, Platts, which is our commodities analytics business, and we're implying the fintech, the technology, and this is an exciting time.
S&P Global is a globally recognized company specializing in providing financial market data, analytical tools, and rating services. Its main goal is to provide market participants with reliable and comprehensive data on financial markets, bonds, stocks, and other investment instruments. It's also known for its S&P 500 index, which serves as a benchmark for the US stock market. This company plays a crucial role in the financial world, helping investors, analysts, and businesses manage risks and make decisions based on current data and market analysis.
We watch the interest rates, we watch what's happening with economic growth. Today, we are very carefully watching what happened with the employment. So these are themes that are embedded across the company.
Its main competitors include Bloomberg, which provides data, and various rating agencies. If you've ever visited Yahoo Finance or used Apple's Stocks app, you've likely encountered data from S&P Global. In terms of the financial situation, the ideal revenue development should look like this: constant growth, slowly and steadily, with no cyclicality, no COVID-related dips, or similar disruptions. This is almost a risk-free business. Data, especially market data, are constantly needed, regardless of whether the markets are going up or down.
We're embedded in the fabric of the financial markets, between the ratings, which are used in so many different ways you won't believe it, to benchmark performance by traders, by analysts, by risk managers. The indexes, you see them used as benchmarks for ETFs, for trading.
The earnings per share, EPS, and free cash flow both look healthy, even though there was a slight dip last year, mainly due to recent acquisitions where S&P Global continuously buys smaller companies with various data models and tries to incorporate them into its offerings. Some of these companies have a focus on AI and advanced data analysis. It seems like the company is staying up to date in this business and not just relying on what it already has.
We've been enhancing our business by adding in new capabilities, new data feeds, and one of the biggest themes that's growing up right now is alternative data, and another one is ESG. So as we have this platform today of foundational analytics tools, we're starting to find demand for new things that we keep adding into our portfolio.
The company also pays dividends, even though it's just around 1%. However, considering that only a minimum of technology companies pay any dividends at all, this is quite decent. Why am I buying this stock? There's high predictability, and it has provided above-market returns in the last 5 years, even outperforming its index, the S&P 500. Another reason is that it's a capital-efficient business. You might need servers and such, but you're not dealing with physical products, logistics, or taking extreme risks. You're providing data and analyzing risks, which aren't as affected by interest rates or the price of money and other external factors. It offers an excellent combination of low risk with an attractive return for me.
We've been in data business for over 150 years, and we know that how to monetize data. We know that it's utilized in a way that's embedded and it's necessary for people to make decisions. And we have subscription businesses and we have transaction businesses, and this is our business model.
The last stock I'm buying right now is VICI. It's a real estate investment trust, right? Which means it acquires properties and leases them to other companies that operate them. In VICI's case, it's a specific type of property, mainly casinos and hotels in Las Vegas. VICI has acquired a significant number of them in Las Vegas and, along with BlackRock, is among the largest owners of casinos in the city. Most of these are usually operated by companies like MGM and others specialized in running such properties. VICI hasn't been trading for very long, about 5 years, but the stock price development is not bad at all. Of course, we can't expect rapid growth right now due to higher interest rates, which aren't particularly favorable for this business. However, it offers a beautiful dividend of between 5% to 6%. This brings us more to the financial aspect. There's not much to complain about there. Revenues and earnings per share are steadily rising, with the most significant jump this year, and even free cash flow looks very healthy. What's bothering me a bit is the recent acquisitions of several casinos, which required taking on debt, and with current interest rates, that's not cheap. The CEO has mentioned that VICI has the option to use its cash for gradual repayment, at least partially, of that debt to reduce interest expenses. This is something I'll be closely watching in the next earnings season. VICI will be releasing its quarterly financial results very soon, at the end of October. You might wonder why VICI and not Realty Income, which has a 6% dividend paid monthly. The reason is that I want to have the maximum possible insight into the businesses I'm investing in. Realty Income has so many tenants that it's much harder for me to monitor their solvency compared to VICI, where I can easily track the profitability of a few casinos and hotel occupancy rates in Las Vegas. Transparency is essential for me. However, I did recently add some Realty Income to my portfolio at around $49, but mainly for diversification purposes, so that I don't have only VICI, and it's a smaller position. Put Warren Buffett's ageless advice to use in your financial plan. His methodical, value-oriented approach to selling equities can lead to financial success.
We got into some terribly cheap market. We might sell some things that we thought were cheap to buy something even cheaper after we'd bought lots and lots of equities, but that's not the occasion right now.
Make intelligent selections, avoid hasty sales, and gradually accumulate riches. Thank you for watching. If you found this useful, subscribe for more investment ideas or share it with others to aid them on their financial path.